Two people, same salary, same savings, same city. One buys a rental property. The other buys index funds. 20 years later, one of them is quietly wealthy. The other one is asset-rich, cash-poor, and exhausted. In the uncomfortable part, the one who lost thought they were winning the entire time. Today, we are running the real numbers, not the napkin math, not the YouTube thumbnail math, the actual full-picture math that most people never see coming. Let's make this concrete. Two people, call them David and Ryan. Both have $50,000 saved. Both earn around $55,000 a year. Same age, same financial starting line. The only difference is what they do with that $50,000. David uses it as a 20% down payment on a $250,000 rental property, a decent 3-bedroom house in a solid neighborhood. He locks in a 30-year mortgage at 7% interest. His monthly mortgage payment lands at around $1,330. He finds a tenant willing to pay $1,800 a month. On paper, that's $470 a month in profit before he spent a single dollar on anything else. David feels like a genius. He drives past that house on his way to work and thinks, "I own that." He's claiming mortgage interest on his taxes, depreciation deductions, shaving a couple $1,000s off his tax bill every year. Every mortgage payment builds equity. Every month, the neighborhood ticks up in value. Everything about this investment feels real, tangible, smart. Ryan takes the same $50,000 and puts it into a total stock market index fund. No leverage, no tenants, no midnight phone calls. He sets up an automatic contribution of $300 a month and barely thinks about it again. His coworkers ask what he's investing in. He says, index funds. They nod politely and change the subject. Nobody's impressed. Day one, David has a house, a tenant, and a story to tell at dinner. Ryan has a brokerage account and a confirmation email. It's not even close in terms of how it feels. But here's the thing nobody warns you about early enough. Feelings and math are two completely different languages. Year one, Ryan's $50,000 grows to roughly $55,000. Year two, maybe $61,000. Nothing dramatic, no key in his pocket, no asset he can point to from his car window, just a number quietly climbing on a screen. David's friends ask about the property at every gathering. Ryan's friends don't ask him about anything. The social proof alone makes David feel like he's winning by a mile. But social proof has never once paid a mortgage. Let's talk about what happens after the rent check clears, because this is where most people's math quietly falls apart. Through year three, David has collected roughly $64,800 in rent. His mortgage payments total around $47,880. That leaves $16,920 in gross cash flow. Sounds great until you subtract everything else. Property taxes, around $3,000 a year. Insurance, another $1,500 annually. He replaced a water heater for $1,200, fixed a leaking roof for $2,800, lost 1 month of rent between tenants, $1,800 gone, plus $600 to clean and relist the property. And David manages it himself to save money, which means phone calls at 10 in the evening, weekend property showings, and coordinating plumbers on his lunch break. After every real cost is counted, David's actual net cash flow over 3 years is somewhere between $2,000 and $4,000, not the $16,920 that looked so good on a napkin. And that number doesn't account for a single hour of his time. Ryan, meanwhile, has contributed $50,000 up front, plus $10,800 in monthly contributions at roughly 10% average annual return. His portfolio is sitting at around $76,000. 0 phone calls, 0 emergencies, 0 weekends lost. Now, here's what the real estate world will correctly remind you. David still has leverage working in his favor. His $250,000 property has appreciated 3 to 4% a year and is now worth around $270,000 to $280,000. His equity, the gap between what the house is worth and what he owes, has grown to roughly $55,000 to $65,000. That is real wealth, and it came partly from using the bank's money. That leverage is the one structural advantage stock investors genuinely cannot replicate easily. But here is what nobody says out loud at the real estate meetup. Vacancy is guaranteed. The average rental property sits empty roughly 1 month per year. That's a full mortgage payment with zero income to cover it. Maintenance is guaranteed. Budget 1 to 2% of the property's value annually for repairs. On a $250,000 house, that's $2,500 to $5,000 every single year. Some years it's a $200 faucet fix. Other years it's a $7,000 HVAC replacement in August when your tenant is threatening to walk. Capital expenditures are guaranteed. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These are not surprises. They are scheduled future costs arriving in chunks of $5,000 to $15,000. If you are not setting aside money every month for these, you are not running a business, you are running on luck. And then there's the risk nobody wants to discuss at the barbecue. A bad tenant who knows the eviction process can cost you 3 to 6 months of lost rent, plus legal fees. One single event can erase an entire year of profit. None of this shows up in the $470 a month number, but it shows up eventually. It always shows up. By year 5, David is deep in the reality of being a landlord. He's on his third tenant. He replaced the roof for $8,500, dealt with a plumbing emergency that cost $1,400, lost 1 full month of rent between turnovers. He's raised rent to $1,950, which helps, but his property taxes and insurance have climbed too. His actual cash-on-cash return, the money he genuinely pockets relative to what he put in, is hovering around 3 to 5% after all real expenses. Not bad, but not the 15 to 20% return he told his friends about at the barbecue. Ryan is still doing absolutely nothing. His portfolio has grown from $50,000 to roughly $135,000 to $150,000 by year 7, including his $300 monthly contributions. He didn't pick individual stocks. He didn't time the market. He didn't do anything except not touch it. And that discipline is quietly becoming his greatest financial asset. The compound growth is starting to accelerate now. The gains on his gains are generating more new wealth each year than his original contributions ever did. This is the part that doesn't show up on a thumbnail. Compounding is boring for the first 5 years and genuinely astonishing for the next 15. By year 10, David's property is worth roughly $335,000 to $350,000. His remaining mortgage balance sits around $166,000. That puts his equity at approximately $170,000 to $184,000. Over 10 years, after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, David's total out-of-pocket beyond the original down payment is somewhere between $20,000 and $35,000. Ryan's portfolio, with consistent $300 monthly contributions and roughly 10% average annual returns, is sitting at approximately $165,000 to $180,000. He put in $50,000 up front, plus $36,000 in contributions, $86,000 total invested. The rest is pure compounding growth, and he spent exactly 0 weekends fixing anything. At year 10, they are surprisingly close in total wealth. David might be slightly ahead, thanks to leverage, but here's what that comparison is hiding. David also spent hundreds of hours managing his property, took on hundreds of thousands of dollars in debt, and concentrated his entire investment into a single asset in a single zip code. Ryan diversified across thousands of companies simultaneously and never lost a night of sleep over it. Now, fast forward to year 20. David's property is worth roughly $450,000 to $500,000. His mortgage is either paid off or nearly there. His equity sits somewhere between $400,000 and $500,000, depending on how the local market performed. After 20 years of maintenance, repairs, turnover, taxes, insurance, and at least one major renovation, his total net profit from cash flow might be $40,000 to $80,000 above what he spent, maybe more in a hot market, maybe less in a flat one. Ryan's portfolio, at 10% average annual return with $300 contributed monthly, has grown to approximately $420,000 to $460,000. Total contributions over 20 years, $122,000. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 in the morning phone calls about a broken pipe. When you compare net worth at year 20, they're in the same ballpark, $400,000 to $500,000 each, but how they got there is completely different. David worked for his. Ryan waited for his. David had stress, risk concentration, and illiquidity. Ryan had volatility, but liquidity and freedom. And here's the part that changes the math dramatically. If Ryan increased his monthly contribution by just $200, bringing it to $500 a month, his 20-year portfolio jumps to roughly $550,000 to $600,000. Because in the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. That asymmetry is something most people never stop to calculate. Now, if I only showed you the downside of real estate, I'd be doing exactly what every stock market influencer does, and that would be intellectually dishonest. Because index funds have real risks too, risks that people love to gloss over, right up until the moment they can't anymore. Volatility is brutal. In 2008, the market dropped roughly 37%. In March of 2020, it dropped 34% in a single month. If Ryan had $150,000 in his portfolio and watched it fall to $95,000 in a matter of weeks, that is not just a number on a screen. That is gut-wrenching. And the data is painfully clear on this. Most everyday investors panic sell during crashes and buy back in after the recovery, locking in losses at the absolute worst possible moment. Discipline sounds easy in a bull market. It becomes a completely different test when your portfolio is bleeding red for months straight. There is no cash flow. Unlike a rental property, index funds do not send you a monthly check you can actually spend. Dividends exist, but on a total market fund, you're looking at maybe 1.5 to 2% yield. On $150,000, that's roughly $200 a month. That is not replacing anyone's income. That is not covering anyone's mortgage. No leverage. Ryan used $50,000 to control $50,000 in assets. David used $50,000 to control $250,000 in assets. That 5-to-1 leverage is powerful when property values rise, and it's the primary reason real estate creates more millionaires than the stock market does in survey after survey. No depreciation shield. Real estate investors can legally deduct the theoretical decline in their building's value from their taxable income, even while the property is actually appreciating in value. That's a legal tax shelter that stock investors simply do not have access to. And real estate wins clearly in specific, identifiable situations. If you're in a market where the rent-to-price ratio is strong, meaning monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. if you're willing to treat it as an actual business, not a side hustle you check on occasionally, screening tenants carefully, budgeting for capital expenditures, building real systems, the returns can genuinely exceed stocks, especially with leverage compounding underneath. If you use house hacking, living in one unit and renting the others, you can reduce your own housing costs to near zero while building equity simultaneously. That's something the stock market simply cannot do for you. And if you understand 1031 exchanges, which allow you to defer capital gains taxes by rolling profits into a new property, you can grow your real estate portfolio in ways that stock investors cannot replicate outside of retirement accounts. Real estate is not a bad investment. It's a deeply misunderstood one. The problem is never the asset class. The problem is always the incomplete math people bring to the decision. David and Ryan both walked away from that decision, believing they made the smart play. David thought real estate was the proven path to wealth. Ryan thought the market would simply do the work for him. Neither of them actually sat down and mapped out what their choice would cost in dollars, in time, in stress, and in risk. That is the real trap. Not real estate, not stocks. The real trap is choosing either one based on a YouTube thumbnail, a podcast clip, or something a coworker said in the break room, without ever running the full numbers for your own specific situation. Because your income is not David's income. Your market is not Ryan's market. Your risk tolerance, your time, your tax situation, your goals, none of them are identical to anyone else's. The math that works for someone else might quietly destroy your financial independence if you apply it blindly. The financially intelligent move is not picking a side. It is understanding both sides deeply enough to know which one fits your actual life. And if you are wondering what happens when you do both, when you own property and invest in the market simultaneously, that is a completely different conversation, and the numbers might change everything you think you know. But for now, the next time someone tells you real estate always wins or the stock market always wins, ask them one simple question. Did you include everything? Because the answer that includes everything is the only answer that actually matters. If this breakdown gave you a clearer picture, the kind of picture most people never get, make sure you do not miss what comes next, because the next video goes even deeper into the numbers that quietly separate the financially free from everyone else.